Today's topic is long-term care a good investment? So I have some pretty strong thoughts on this, but I want to just say on the front end to kind of set the stage here a little bit. Facts are greater than fear. So what I mean by that is there's going to be a lot of people out there that are going to almost try to scare you in to doing long-term care insurance or some different alternatives to some of these long-term care ideas that we'll talk through. And I want to try as much as possible to remove fear from this whole discussion. So I'm gonna kind of show you some of the ways early on in the presentation that people kind of use fear as a tactic to try to get you to do something that may not be in your best interest. And then through the kind of the middle and the end part of the presentation, I'm gonna kind of take the fear mode off, take that hat off and really drill in and focus on some of the facts and numbers and frankly some of the unique situations that you get when you look at long-term care. Final quick note: everyone has unique goals. So what do I mean by that? I might say something in here that is totally counter to your situation and counter to your goals. This isn't advice for your situation. This is really just supposed to be educational. And, hopefully I think anyone, regardless of where your knowledge base is in long-term care, I really hope everyone can take something away from this presentation. So let's start with some of those fear stats. So first off, this is from longtermcare.gov. And they say, basically one of the first or second sections on the website, nationally, the average cost for long-term care is $225 a day or $6,844 per month. That's for a semi-private room in a nursing home. So that's not a private room even, that's just semi-private room. And they also have a stat on their site that 60% of people will need long-term care at some point in their life. So then kind of where they'll typically go from here, this is not off LTC.gov. I can try and get the site for this, but this is a very common chart you're going to see all over the internet when it comes to long-term care. And they'll actually show you the different types of long-term care. So you'll see up to the left there, it says any services. The average number of years people use that type of care of any long-term care. That can mean unpaid, meaning like friend or family member. That can mean paid care, which could be at a facility or at home. But the average length of time that somebody needs care is 3 years. And you'll see there 69% of people need any type of long-term care. So you can see right off the bat, they're saying there that 31% of people won't need long-term care. But at home, if we look at, say, any care at home, the average person needing that. So I'm on kind of the fourth row there. So down in that second group are all the at-home blocks, and that bottom one in that block is any care at home on average. 2 years of care at home. And then you can see if you go into a facility, on average, it's about a year. Okay. And the 35% of people will need to go into a facility, average 1 year. So one of the first questions that we'll get around long-term care, and I should say we get a lot of questions about long-term care. One of the biggest ones that we'll get is, why do I have to worry about long-term care? Medicare is going to cover it. I don't know where this came from. I've heard a lot of people say something to this effect. And the fact is, Medicare does not cover long-term care. Okay, there's some situations where you can get, things that are like long-term care to be temporarily covered and different stuff like that. I'm not going to get into it all. I'm not a Medicare agent. Talk to a Medicare agent if you want to learn more about Medicare. But the key thing here is Medicare does not cover long-term care. So if you do not have a plan in place specifically to address long-term care, your entire long-term care plan is riding on you. Okay, and we'll talk about some of the different alternatives, but one of the most common tactics that I'll see around long-term care is this one. So they'll go, hey, on average, people need 3 years of care. You can see it at the top row on this sheet. And they'll go 365 days in a year times 3 years times $225 a day. That was that average cost that we saw earlier. That means the average person has a long-term care liability of $246,000. Okay. And then they'll say a married couple has a long-term care liability of $500,000. We're going to go through a different way to look at this. That's a little bit more probability based, where I'm going to say a lot of those numbers, in my opinion, are just grossly inflated. But let's roll with these for a little bit. The next thing that they'll do is they'll talk about filial loss. So these are important. Okay. So it is key that you understand these. They are a very real issue. And I should say too, I don't want to minimize, like long-term care can get extremely expensive. Like I don't want to just make light of all this. I've had family members paying $10,000 a month, that were in a memory care type situation. And I totally understand it. But what I'm trying to do here is show you the common ways that this is sold. And then in the back end, I'm going to show you some of the statistics backing up why I would look at this a little bit differently. But anyway, filial loss. So filial responsibility, if you've never heard that term, a filial law means that an adult child of an impoverished parent has the legal obligation to pay for the necessities of the parent who cannot do so for themselves. And then you'll get these maps where they show it, say, here's the 30 states that have filial laws. If you go into one of these states and you don't have a plan and you go into long-term care, you're going to bankrupt your kids and stuff like that. And again, we're going to go through an actual case here in just a second, but the bottom line here is that these are real. There are filial laws on the books, and we'll come back in just a minute to why I'm not quite so worried about them. But here's first. This is one that I saw in a presentation. So this was when I went to a long-term care dinner with a family member and sat there and watched. And this was one of the ones that they did. So it says ABC News, Pennsylvania man appeals to court to avoid paying mom's $93,000 nursing home bill. So what happened here is mom goes into a long-term care facility, recovers, doesn't need the care, goes to Greece. Okay. So she leaves the country. So then they're in Pennsylvania, which on this map, you can see off to the right there, Pennsylvania is a filial law state. Pennsylvania sues her son for the $93,000. And the court, you'll see down below right here in the kind of the middle of the screen, it says, John, I'm gonna butcher the name. So I apologize, John, wherever you are, but it says John Pittas. John Pittas is appealing a Pennsylvania court that ruled he must pay the bill. So Pennsylvania long-term care facility sues John, go to court rules John owes 93 grand. Okay. So that's an interesting dinner table conversation, right? At the next Thanksgiving. Hey mom, I got a bill for $93,000 here from your long-term care facility. But anyway, yeah, he appealed it. I didn't go digging for an update, but my guess is he probably had to pay it because there are filial laws. But if someone has a little bit more info on that, especially out on YouTube, drop it down below in the comments. I would like a little bit of a follow-up if you know the full story, if you're out in Pennsylvania or you operate in the long-term care space and know a little bit more on this particular story. I'd love to see how it ended. But regardless, I want to take a time out here for a minute and emphasize the more, I'm going to call it the under the hood math. So what I mean by that is we're going to look at some probabilities and we're going to look at how you value those probabilities in just a minute. But first, okay, so this is more just to know the stats. I'm not going to poke any holes in this piece. The average cost nationally is $225 a day, and 60% of people are going to use long-term care. Okay, again, that's right off of the longtermcare.gov website. What I want to call attention to now is a little bit of a technicality. So I have the blue arrow up there, kind of top left part of the screen where it says the average number of years that people use this type of care is 3 years. So what that means when you have an average is you have some people that are a little bit over that average and you have some people that are a little bit under that average. What you're going to have with long-term care is a much larger spread. I have a great visual coming up in a minute. You're going to have some people that need long-term care for 6 years, and then you're going to have some people that need long-term care for 90 days. And the average actually tends to be a little bit on the shy side of 3 years. But regardless, look down below in kind of the middle of the screen. I have another stat that I kind of, Eric would never just drop it that ugly right in the middle of the table. But it says 48% of people receive long-term care for less than 1 year. That's according to Morningstar. So you can probably see where I'm going with this, that the averages might slightly inflate the risk for the bulk of people. And I'll also show you what some of these numbers, how they play out right at the very end. But I also want to call attention to this filial law situation. So if you do a little bit more digging on filial laws, this was from law review article published by Catherine Pearson, a professor with Pennsylvania State University's Dickinson School of Law. She looked at all the states with filial laws, which are all those states from the first map. You can see kind of the overlap there, but then she specifically went into the legal history in the states, probably through LexisNexis or something, and looked up how many of these states actually enforced filial laws in the last 20 years. And what you'll see is there's only 3 of them. So South Dakota, Pennsylvania, which we just saw that case, right? And then Rhode Island. And I'm color deficient, they call it. So I can't tell if Puerto Rico is one that has enforced one or not. But actually, yeah. So it looks, if you read above, I should have dropped the 4th arrow on there. Puerto Rico as well. It looks like if you read in the thing above, it says Pennsylvania, Rhode Island, South Dakota, and Puerto Rico are the only places that have actually used filial laws to collect debts on a child of a parent that has debts. So those 4 places. So what I'm getting at there is, if you're in one of these other states, so like, let's say you're in California, and I think that's an interesting one, where I think there was actually a recent attempt by California to collect on filial laws that I've just recently seen in the news. But let's say you're in Nevada or Iowa or Utah or one of these other places on here. It's probably unlikely that filial laws are going to be used to collect parents' debts. Now, that being said, there is a big danger with long-term care, and that danger is basically the legacy of your parents gets wiped out by the cost of care, and that's a very real thing. But I'm not an attorney, so I want to be really careful how I frame this. If I was in one of these other states, so if you can go to your own state, you could even find an attorney in your area. An estate planning attorney is probably going to be the type of person that's going to know about this, and just say, hey, today, right now, as I'm recording this, it's early 2022, but does this state have filial laws? Could I be responsible for my parents' debts? Could my kids be responsible for my debts? Talk to a couple attorneys. That's the type of question, you could probably even punch into Google and get more up-to-date information. But if I'm in a place with no filial laws, I'm not going to worry about that. And even if I'm in a place with filial laws, I'm going to probably just do a little bit of research and just see, hey, when's the last time that the state actually used, or I should say a long-term care facility actually used these laws to try to collect a debt? Probably not as often as you think. So now we're going to get into the real meat and potatoes of this presentation. So this was the most detailed and most well-researched data that I could find on this question. And my question was, what is the actual breakdown of how long people need long-term care for? So you'll see they broke it out in terms of men and women. This is very interesting just right off the bat. So if you look at the top line there, it says percentage who will need care. Men, 58%, women, 79%. Why is that? Well, guys, we tend to pass away a little bit earlier, and the female is usually there to help us while we're getting sick, and then we pass away, and then she doesn't have help. So that's why you're going to see, I think I saw a stat recently that 70% of nursing home populations are women. And it's just the nature of the beast. They live longer than us, and they're there to take care of us, and then we're not there to help them out. So the percentage of people, though, so this is a slightly different statistic. So longtermcare.gov said 60% of people are going to need care. This study by Kemper, Casamar, and I can't get that one. I'm not even going to try that name, but 2005 study, they said their number was 69% of people will need long-term care. So you could go look at 5 different sites, you're going to get 5 different numbers, but let's just say there's something like 30 to 40% of people do not need long-term care. Then if we look at the people that actually need long-term care, let's go down. So the average numbers of years for men, it's 2.2 years. For women, it's 3.7 years. But then go down one more. Percentage needing no care. 42% of men don't need any care. Again, that's like paid care in a facility or at home. And 21% of women, 21% of women need no care. 31% of the population isn't going to use any long-term care. Percentage needing 1 year or less. So again, this is home healthcare, or I'm in a facility for less than a year. 19% of men, 16% of women, 17% overall. Okay, so if we just add up the people that need no care And the people that need a year or less, we're getting really close to 50%. So we're already at like 48% of people either need no care or they need 1 year or less. Okay. And then we have the 1 to 2 years, 2 to 5 years, and 5+ years also on this chart. I'm going to talk through those in just a minute. But what I want to do is actually go through a real case. So this was a person that came to us. They said, hey, I know you guys are not big fans of long-term care insurance, but can you look at this policy I have and tell me what you think? And I changed these numbers to protect their privacy, but just very slightly, just adjusted them slightly. The overall outcomes are the exact same. But you'll see up top there, so the premium, this was a life premium. So they're paying that $3,200 a year for the rest of their life. 90-day elimination period. That means when they go into a facility, they're not going to get any benefits for 90 days. Okay, that their benefits basically start on day 91. Lifetime maximum benefit of $180,000. So again, that means the most you're going to get out of this policy is $180,000. And then the daily benefit is $150 a day. So first off, I just want to call attention to this. $150 a day. What did we say the facilities cost right now? About $225 a day. So you're already taking $75 a day worth of risk, even if you buy this policy, even with the annual increase, because let's say those costs are going to keep going up. They're starting at $225, you're starting at $150. So you already have a fairly big liability there, again, $75 a day. But then the bigger thing here is I want to look at the long-term ROI. And what I'm going to challenge everyone to, anyone that's watching this, what I'm going to challenge you to do is think like an insurance company. So let's assume here that you're 60 years old watching this right now, and you're thinking about buying this policy. Again, this one right here with the $3,200 a year with the $180,000 lifetime maximum benefit. If you go into a facility at 85, so that'd be 25 years from now, the $150 daily benefit will have grown to $314. Okay, so a little bit more than doubled, and that's great, but the care cost probably went even higher. It went from $225 today to probably $400 or $450 or something. But you do, at least, I don't want to minimize, if you had that policy, you do have $314 a day of benefit. But now look at the lifetime maximum. So again, on that policy, that third bullet there where it says lifetime maximum, $180,000, that means they're going to pay you out $314 a day until that lifetime maximum is used up. And now, after inflating that, $150 daily benefit for 25 years, and it's now $314. Well, now if we take 180,000 divided by $314, we get just 573 days. So that means you only have a year and a half of care. And remember, they eliminate the first 90 days. So there's a really nice visual here that helps with this. So this is some longer term data showing the length of stay in nursing homes, and it's like months. So you'll see here, the bulk of people, you're talking 1, 2, 3 months that they're in a nursing home. And then they, again, some people recover and get out, but a lot of times they pass away. And you'll see that for the bulk of the people here, you're really talking under 6 months for a whole big swath of the population. And there is a lot of risk. If you look out at month 67 and 73 and 80, there are some people out there that are in a facility for a very, very long time. And that's the real danger of the long-term care risk that people take, that really long-term need. Like, let's say you need memory care and you're physically very healthy. If you're in a facility for 10 years burning $10,000 a month, that's over $1 million. Okay, so there is some real risk there. My point that I want to make is I don't think long-term care insurance is the best way to address it. So let me show this. So first off, they're going to eliminate the first 90 days. So you're going to get no benefits there. Look at the bulk of, just look at the raw numbers of how many people are only in there for one month, 2 months, or 3 months. And they're saying, we're just not paying any benefits for that period. Okay. Then remember, you're hitting the maximum benefit at like 19 months in that particular contract. So they're also not going to pay out on any of the other months that are longer than that. So basically, once you hit that $180,000 full benefit, you're done. That policy is not paying out anything beyond that. So really, you only have insurance on that little piece in the middle. So from 91 days out until your maximum benefit gets hit. Now we're going to talk about the ROI on that policy as the policy owner. And if you're if you get lucky and basically max this out, how you did on your money, what type of value you got for your money. So again, let's think about this. Best case scenario for you as the policy owner, worst case scenario for the insurance company, best case scenario for you, you exactly max out your benefit. Why am I emphasizing exactly? If you go into a facility and let's say you go beyond that maximum benefit, well, yes, you maxed out your policy, but now you are burning the full value on your own every day, and the policy is not contributing anything. So basically on day 574, well, actually, I should say day 90 plus 574, but let's, whatever the number comes to, day 650 or something like that. Actually, what would that be? 663. So from day 663 and beyond, you don't have any benefit anymore. So best case scenario would be you use up the entire benefit, and then on the exact day that it runs out, you pass away. Okay, because if you go beyond that, you're just really, really burning more cash. So we can look at the numbers on this. So again, think like an investor here. We're going to look at something called IRR, internal rate of return. You pay $3,200 a year for 25 years. So you pay in $80,000. And then at the end, over a pretty short period of time, about a year and a half, you get $180,000 back. What is the internal rate of return on that? So again, 80 spread out over 25 years, 180 coming in at the end. The internal rate of return is 5.63%. So again, best case scenario, the best it can possibly do is 5.63%. That is the best way this deal can turn out for you. Okay, now let's look at some of the other ways it can go. What if you pass away in the first 90 days? Okay, well, then your internal rate of return would be negative 100%. What that means is you pay in $3,200 a year for your entire life. You've paid in 80 grand, for that whole 25-year period. And then you pass away and you haven't collected a single dollar of benefit. So you are minus $80,000. The only asterisk I'm going to put on this is if you pay extra to buy return of premium. Return of premium coverage basically means, you pass away and haven't used any benefit, they give you back your premiums. And I'll just say that generally this 5.6 number in a best case scenario is pretty much what you're going to see for the best case scenario. In fact, on a lot of them, you're going to see lower numbers. You're going to see a 4% rate of return, 3% rate of return in the best case scenario, even if you do the return of premium, because what they'll do is they'll just raise the premium up to try to, equalize it out and get the 4 or 5% return to you. So here's another question. What if I only receive 1 year of care? Oh, well, that seems like it might be a good benefit, right? But not so fast. Because again, there's a 90-day elimination. So I'm going to I realize now that I should have used, I think 275 days, but 270 days, let's say I'm going to make it almost a year, 270 days, $314 a day. I'm going to get $84,780 in benefit from my long-term care insurance policy. But think about that. You paid in $3,200 a year for 25 years. So you've paid in 80 grand. And then at the end of that period, you get $84,780. What's the internal rate of return on that? Pretty brutal, 0.15%. Okay. So again, we're gonna go back through and basically overlay the table of the probabilities of how long you go with the values at those various probabilities and talk through some of it. But there's a whole nother thing. What if you just go through your whole life and you just never need long-term care? Ever. Remember, that's 30 to 40% of people. Your IRR is negative 100%. Again, unless you pay extra for return of premium, your heirs just basically don't have anything to show for it. So what I did here is I made a little table. So I went back, I'm going to go back here. I went back to this table right here, and I only used the total column at the end. So basically men and women combined, I only used that column. So let's skip ahead here. And what I did is I calculated the internal rate of return. You could also just call it like the return on investment. I calculated the return on investment for all these various periods. So again, if you went, say, right in the middle, let's say you went 1 to 2 years, I just assumed it was 2 years and you max out that whole, benefit. It would be 5.6% internal rate of return. Okay. If you go beyond that, it's going to stay at 5.6%. Why is it not going up? Because you've already maxed out all your benefits. So the longer you stay now, you're just paying more out of pocket. You're not getting anything else out of the policy. If you're in the facility for less than 1 year, I just assumed the full year. Again, I'm in each one of these brackets, I'm doing like best case scenario. The full year, rate of return 0.15%. Okay. If you don't need care or need less than 90 days worth of care, the return on investment is negative 100%. Okay. And I want to just call attention to this. So if you look at less than 1 year and no care, you have 37% and 30, or sorry, you have 17% and 31%. So that's 48% of the time, your return on investment is either going to be nothing. You're going to get your money back, 0.15%, or negative 100%. You're going to just lose all the money. So if I came to you with the following investment and I said, hey, we're going to flip a coin, and if it lands heads, we're going to flip the coin again. And if it lands heads, you get your money back. And if it lands tails, you lose everything. And then go back to the first flip and say, if it lands on the other side on the first flip, you make 5%. Does that seem like a pretty good trade-off to you? So basically, hey, 50% of the time, you're going to make 5%. 50% of the time, you're either going to lose everything or break even. Because to me, that doesn't seem like a very good trade-off. That seems like I'm taking gigantic amounts of risk here in exchange for very, very limited upside. I mean, we haven't even talked yet, but like, what if inflation is at 6% for a prolonged period of time? You're generating a negative real return in that environment. Okay. And that's without even getting into some of the technicalities of like your ability to actually end up getting paid by these contracts and all that type of thing. But just again, if we're going to, the other way to say this is maybe like roll a die. And if you get a 1, you get your money back. If you get a 2 or a 3, you lose everything. And if you get a 4, 5, or 6, you get a 5% return on your money. Again, when you put it in those terms, I hope like me, you think that that's absolutely crazy and I would never agree to that. And I think most people are just not thinking like the insurance company because they see this from the totally opposite side. They see it as there's a 31% chance this is straight profit. Okay. There's a 17% chance this is break even. And then in these other periods where we might have to pay out 5%, we don't have to pay that 5% out until 20, 25, 30 years from now, and we get to invest that money for that whole time. So I think as the insurance company, I'm really liking these contracts. So what's interesting is this was an older contract. Nowadays, when we see some of these contracts, we will see even lower ROIs in that ROI column over there, where it'll be 4%, stuff like that. And I do want to say, so if you came to us and said, I have this long-term care policy here, can you take a look at it? So I pretend you're a client of ours, and in one of our reviews, you bring in this long-term care policy and we take a look at it. If you were starting this from scratch, my recommendation as a fiduciary would be to not start this contract. Now, I want to back up. Pretend you're 15 years into it and you're 75 years old and you're still paying the $3,200 a month. It would really change the ROI, because I wouldn't look at the $3,200 a year for 15 years that you've already paid. I would only analyze the $3,200 a year for the, say, 10 to 15 years going forward, and the ROIs would look a little bit better. So timing's everything. I mean, just like everything else, you come in and you start one of these contracts when you're young and healthy and get good rates and all that type of stuff. I would probably still tell you not to do the straight long-term care insurance, but if you've already done it for 10 or 15 years, by the time we take a look at it, it might actually be good ROI when you don't consider the money you've already thrown at it, because that money is basically gone. So we're only thinking about, say, the next 10 years, the next 15 years. How is it going to look just from this date forward? So that being said, I want to emphasize here that I'm not saying that long-term care is no big deal and don't think about it, because that is definitely not the case. You absolutely should think about it. There is going to be a drain on your legacy if you don't address it and don't think about it. But what I'm saying is, it doesn't mean you should go just buy long-term care insurance. Okay. In my opinion, there's at least 4 ways to handle long-term care. So the first one is to just self-insure. And what I mean by that is basically, I think you're going to do better than 3 or 4% a year on your money if you invest for the long haul. And I would rather just have the liquidity and not have all those downside conditions of, if I don't use this, it's gone. So again, if you invest the money and then go into a facility, you don't have an elimination period. You can start using that money immediately. And if you don't go into a long-term care facility, your heirs get that money. If you only burn 30 grand in the facility, your heirs get the rest. So I'm a huge fan of self-insuring when it makes sense. I don't really use rules of thumb either. I tend to work with Eric, and we look at like Monte Carlos and different scenarios, and we would base that self-insurance situation based on a lot of other things, your pension, your other income, different things like that, if you have one. Number two, spend down. This is fairly difficult for most people to qualify. And what we're really talking about here is like Medicaid spend down. And that's a situation where basically you give all your money away and you leave yourself very little, and you try to get the state to pay for your long-term care. I've seen it done with some pretty advanced trusts. But in general, I would just say this is by far the most complicated way. It's fairly expensive. So it's not as expensive as like long-term care insurance, but it's fairly expensive to set up, irrevocable trusts and, all sorts of different things like that. And there can be, in my experience, a lot of unintended consequences for that, just due to the complexity. And there's no guarantee that that system's still going to be there by the time you need long-term care either. So then number 3 and 4 are options that nobody likes. And then number 3 is annuities, and number 4 is life insurance. So we're going to go through each of those in a little bit more detail, because I really want to get into some of the pros and cons. So I could do some pros and cons on self-insuring really quick. The biggest pro of self-insuring is your money's liquid the whole time. You have the potential to make more than 5% on your money. You don't have any kind of elimination or qualification period. Your heirs get the money, all that good stuff. The spend down. The pros are this: if you make it work correctly, the state pays for your long-term care. The cons are everything else. So it's expensive. You got to do a lot of really complex planning. There's a lot of potential family dynamics that can come into play, where you're basically giving all of your money to an irrevocable trust, or giving all your money straight up, gifting it away to your kids and all that type of stuff. And it gets very complicated. We don't focus on a lot of this just due to the con list being very long, but it is something you might want to ask your estate planner about. Okay, so on annuities and life insurance, I want to spell those pros and cons out a little bit differently. So if you look at long-term care benefits from an annuity, they are generally an added rider fee. So if you know us, if you've been following our YouTube channel, if you've been a member of Retirement Mastery, you know that we don't like riders. We don't think riders are a good fit for the vast majority of people. We don't like added fees, all that good stuff. So generally, when you see long-term care benefits, there's an added fee, but some are free. So there's that little asterisk that sometimes you can get some of the income doublers and things like that for free. Usually the way they'll work for an annuity is they will give you a multiplier of your income. So what that means is, let's say you have $1,000 a month of income. If you go into a facility, or you need home health care because you can't complete 2 activities of daily living, your $1,000 a month income will literally double to $2,000 a month. There we go. So there is one other area here where annuities can get interesting, and it's something called a nursing care waiver. And what that means is, even in an accumulation style annuity that has no fee and a principal guarantee and a little bit more upside, if you own one of those, you might want to look into the contract and see if you have a nursing care waiver. Because then what it'll do is, whether you're in a facility or at home, if you can't complete 2 activities of daily living, your annuity's liquid that day. Okay, so you might not want to just automatically, just because, hey, Tony and Eric say, 90+% of annuities are garbage, you might not want to throw them away. You might want to look at first, what am I paying in fees? What kind of nursing care waiver do I have? What kind of access do I have to this money? Different things like that. Because you might be surprised. There might be more bells and whistles attached to that annuity than you think. So the biggest pros to annuity-based long-term care, usually, not always, but usually you have a lifetime boost in your income. So if you get into one of those situations where you're in a facility for a super long period of time, the annuity is probably going to be one of the top ways to handle that in just terms of raw ROI. Because if you need that care for 10 years or something, that annuity is paying out for life. So that's a big deal. Number 2, biggest pro, is it is possible to find all this stuff, the income doublers and the nursing care waivers, with no added fee. I would say typically the waiver route is, I don't want to say always, I almost said always, that would have been bad. Very common that you can find the nursing home waiver for free. I would even say for a lot of the top like market leading carriers, it's kind of table stakes now. Like you have to have that in your contract or nobody's going to do it. And then number three biggest pro is heirs receive any remaining account value unless you annuitize. We very, very, very rarely recommend annuitization. I think in 10 years as a financial planner, I've told one person to annuitize. In general, you're not going to want to annuitize for this top reason right here. The biggest con to annuity-based long-term care is guaranteed income can destroy your tax plan. Eric has talked about this at length. Guaranteed income takes away a lot of dynamics from your plan, the ability to be flexible, the ability to shift, the ability to move around when tax legislation hits and different things like that. Guaranteed income can absolutely destroy your tax plan. Number two, with annuities in general, can be very difficult to spot hidden fees. I can't tell you. And so it can be very difficult to spot those hidden fees. And then number three, there's a lack of liquidity with annuity-based long-term care. Generally a lack of liquidity early in the contract where you might have to wait 7 to 10 years before you have full access to that. Again, the one asterisk being if you meet that nursing home waiver and you go into a facility, you have liquidity immediately, even if it's, year 2 or something like that. But let's move on here. So the last section is long-term care benefits from life insurance. You have section 101G living benefits. They are usually a percentage of the death benefit. So that will often work like this. If you can't complete 2 activities of daily living, they call those ADLs, you have access to up to 2% of the death benefit per month, up to 90% of the death benefit. That's just an example. Okay, some of them are 70%, some of them are 80%. I've seen 95%. But in general, what they'll do is, let's say you have a $500,000 policy, they're going to give you access to whatever the 2%. I'm just having a brain fart here because I'm getting all these messages that the Zoom is bogging my computer down. So 2% of that is going to be $10,000. So they'll give you, I'm a little embarrassed, I couldn't come to that in my head, but $500,000, they're going to pay you $10,000 a month until 90% of that death benefit has been used up. And I'll just be real mean and blunt on this. The main reason they're giving you those long-term care benefits at all, they call it like an accelerated living benefit or an accelerated death benefit, is because they don't expect you to live very much longer. And as the insurance company, they're kind of going, hey, we're going to be paying out this death benefit soon anyway, statistically. So, if we can just pay out a little bit in advance and it makes people happier with the contract and all that type of thing and more likely to buy it and all that good stuff, they're going to go ahead and offer that because to them, it doesn't seem like a very big added cost. Now, the biggest pros to life-based long-term care, this is my opinion, but this is my opinion after looking at literally hundreds of these, is it is often the cheapest way to purchase very large long-term care benefits. So if you want $1 million of long-term care liability risk coverage, which again, I think that's a little excessive, but usually life insurance is going to be the cheapest way to purchase that. The other big benefit of this, of course, is there's that death benefit for your heirs. And I know right now people, our average client has done really well and they have, a bunch of money put away and it's been growing really well. And they're like, I don't really need any more death benefit. What if Congress reduces the estate exemption back down to 500,000 or something, and any amount over that gets taxed at 50%? Well, then you might want some death benefit to try to help absorb the blow of that estate tax. There's also big time tax advantages with life insurance. Just in general, the life insurance lobby is super strong. They've had some tax advantages in there, like Section 7702 and Section 101G and a bunch of different things like that. A lot of big tax advantages when it comes to life insurance. So the cons, I think, are obvious. So the biggest downsides to having life-based long-term care is even with some light underwriting, like there's some companies out there that'll offer things like this, where it's like 10 health questions and stuff. You still do need to have a reasonable health outlook. If you have a whole bunch of health conditions, they're not going to do one of these deals. Number two, of course, is limited growth potential. If you're doing one of these contracts in general, I would not be doing it to try to bet on the growth and try to bet on, pulling cash value out or borrowing against it down the road. I'd be doing it for the death benefit and some of the other accelerated death benefits. That's the only reason I'd be looking at life-based long-term care. And then number three, the biggest con to this in general, the biggest downside is just cost. Okay, so you are the insurance company. I don't care if it's an annuity or long-term care or life insurance. They are not doing this for free. So it's not always a fee. It's not always a direct expense. What a lot of times it'll be is they're going to take away some of the upside so that they can make sure they're going to be profitable on the deal. And you are always paying for it somehow. So if it's not clear to you, ask your advisor, because the insurance company is always making money. And as Eric has said probably on this channel a couple of times, you're never going to beat an actuary. So in summary, I don't want to minimize long-term care is a very real concern. It is a situation where you're probably looking at, $250 to $300 a day in terms of liability. There's a chance that you are in a facility for quite a while. There's a 48% chance you're not going to be in a facility or going to be in one for less than 90 days. So basically means coin flip, one of those coin flips, you're not going to get any benefit at all from long-term care insurance. But long-term care insurance is often a mediocre deal at best. And there are many alternative solutions to help meet long-term care and legacy goals. Some of those are, life insurance and annuities. More commonly, I'm seeing more and more clients just self-insuring this risk and basically just saying, I'm going to try to just grow my money by more than the 3% break-even rate and just, do what I can that way. So as always, you don't need more money. You need a better plan. This is Tony Hellenbrand from Safe